Okay, so today we look at cash flow statements. I want to give them a go at this side of Christmas. I know we haven't finished them in class, and I'm hoping we'll have them. We'll have a good stab at them by the time we break up there late next week. But if we don't have them finished, I'd like to at least have this video up. So for anybody who's interested in getting a little bit ahead over the Christmas, they can maybe give it a go. So, a cash flow statement is a legal document that must be produced by PLCs with the aim of showing the movement in cash from one year to another. Now, as a result of that, your question will give you two balance sheets. Your most recent one will be to the left here, and then you go back one year and it'll give you a second balance sheet. And from just these two balance sheets and a little bit of information at the bottom, we're able to work out the change in cash from one year to another and the change in debt from one year to another and the reasons behind both of those. Now, cash flow statements are fairly popular question type, certainly as a 60 marker, which most of you probably won't end up doing, with the State Examinations Commission. Now, the reason they're popular is there's loads and loads of ways of asking the questions. So, as a result of that, they're not really that predictable in the way they're asked, and you just have to take your time and work through it sort of line by line. Now the first two parts are relatively straightforward. They can only throw in one or two little small things into it, but they can throw in some little curveballs. Anyway, what are you asked to do? You're asked to prepare an abridged profit and loss account to ascertain the operating profit for the year ending 31st of the 12th, 2011. So an abridged profit and loss account is a shortened profit and loss account. And you're asked to work out the operating profit. So basically the operating profit is going to be your answer. So that's the last point within your abridged profit and loss account. Now the reason it's the last point is that we work from the bottom up. So if you think about now we have unpublished accounts, but when we do get to them, when you think of a published account, from operating profit down to profit and loss balance, they are the things you have. You've got your profit and loss balance, dividends, taxation, debenture interest, and investment income. Okay, so that's what goes in here. So as I said, we work from the bottom upwards. And now I am just going to highlight what are answers here. I'll just bold them out. So that retained profit is an answer. Profit after tax, profit before tax, and operating profit. So they are answers. So all of the other ones we can put in from these balance sheets. So we'll start here with the profit and loss balance 31st to the 12th. So if we go down to our finance by, the profit and loss balance at the end of the year is 196,000. So we just put in 196,000 there. Now you'll see they're positive numbers. The one from last year then, profit and loss balance 1st to the 1st, is the profit and loss balance 31st to the 12th from last year. So what you have at the start of the year has to be what you end up with. So that's that 31,000. So then we're looking at an answer. So what number plus 31,000 equals 196? So basically, wherever there's a plus when we're working backwards, we take away. So in effect, it's 196,000 minus 31,000 gives you 165,000. And if you just want to double check, if you're not sure, 165 plus 31 is 196. Now, dividends is next. So there's no real mention of dividends there at all in the balance sheet. There won't be, as you know. So the dividends has to be mentioned in here. So it tells us the total dividend for the year is 5 cents per share. Now we're doing the accounts for the left hand year, so we're working off the left hand balance sheet. So it's 5 cents per share. So we look at our shares and we have 800,000 shares this year. So 5% of that is 40,000. So 5% of 800,000 is 40,000. Now we know that we take dividends away in our profit and loss account. So it's what number minus 40,000 equals 165. So working backwards, add on. So 165 plus 40,000 is 205,000. Okay. Then we've got our taxation next. So again, we're looking to see what the taxation charge for this year. Now there is mentions of taxation here. There's a corporation tax of 110, which is what we owe at the end of the year. So it's creditors' amount falling due at the end of the year, which means we owe 110,000 at the end of the year. This 45,000 over here means we owed 45,000 at the end of 2012. So that doesn't quite tell us what the corporation tax bill for the year is. So generally, again, you will find that in the adjustments or the notes to the accounts. So it doesn't tell us what corporation tax for the year is, but it does tell us the corporation tax due at the end of the year was paid in full. So at the end of last year, at the end of 2010, at the end of 2010 we owed 45,000, and if the 45,000 was paid in full, that would mean we owe the tax office is no euros. If we made no profit this year, we would owe no money. So if we don't owe them anything, and then at the end of the year we owed them 110,000, that means the tax for the year must be 110,000. Now in some of the questions it'll just tell you what the tax charge for the year is, and it will say it down here. But in this one it gave us that bit of information for us to be able to work it out. So again, what do we do? Some number minus 110 equals 205. So if we just add them together, that brings us to 315,000. Okay, so that leaves us with our debenture interest and our investment income. So the debenture interest, again, is there anything there to tell us about debenture interest? Not really, so there's nothing at the bottom here, but as we know, debenture interest is on debentures. So it tells us debenture interest, the rate is 10% and the debentures is 200,000, and it was 250 last year. So let's look and see what this says here. So it says 50,000 redeemed on the 31st of 12th 2011. So that means it's paid back. So on the very last day of the year they paid back 50,000 euros. That means they had the 50,000 euros right up until the very last day, which means they have to pay interest on it. So it is not 10% of 200,000, it's 10% of 200,000 and 10% of 50,000 added together, or 10% of 250,000. So that would be minus 25,000 up here. Okay. Now, the investment interest. Now again, we see we've got investments. Now when we have investments, we'll have investment interest. It tells us there's an investment interest due. Okay, so there has to be investment interest somewhere. So again, we go down to our bottom and we'll see what the investments are, what the investment interest is. So we'll come down here to number 3 and it says the quoted investments yield a fixed return of 5% per annum. So it doesn't matter how much we've received, we are supposed to receive 5% per year. So 5% of what? 5% of this year's investments. Now they both happen to be the same number, but it's 5% of 60,000, which is 3,000. So to find our answer, we've got started off at 315. Now we've got some number, add on 3,000 minus 25 equals 315. So if we work backwards, it'll be 315 plus 25 minus 3, which is 337,000. And Shin A, job done. Alright, so that's the first little part of our question. And that's worth probably 18 to 20 marks in your leaving cert. Okay, so the second thing is prepare the cash flow statement for Danton for the year ended 31st of 12th, including the reconciliation statements. Now there are 2 reconciliation statements. You can't actually do the cash flow statement without having done the first one. So the first one is the reconciliation of operating profit to net cash inflow from operating activities. Now what that means is how much of our profit, our operating profit, is a net cash inflow, so is leading to cash coming into our business. So of the 337,000, what sort of a cash inflow are we going to get from that? Now, the reason you have to do that is all businesses have non-cash incomes, so incomes that increase their profit but don't actually increase their cash. Things like a decrease in bad debt provision will be one, or a profit on the sale of an asset. So there are things we have to look out for. If there's a profit on the sale of an asset or a decrease in bad debt provision, we have to adjust this. We have to take into account that here. The second part is the expenses. So in the same way as we've non-cash expenses or non-cash gains, we also have non-cash expenses. So things that reduce our profit without reducing our cash. So the examples we can have there are depreciations, and also if there was an increase in bad debt provision, we have to take account of those there. So we can have depreciation, increase in bad debt provision, decrease in bad debt provision, or profit or loss on the sale of something. Again, the same way a loss is an expense, that could decrease our profit without decreasing our cash. And then the three other standard ones we have are change in stock, debtors, and creditors. So a change in stock, if our stock goes up, if our closing stock goes up, it increases our profit without increasing our cash. If our debtors go up, it means our sales have gone up. So, but our cash hasn't improved. And if our creditors go up, it would mean our purchases go up, which would reduce our profit and so on, without actually changing our cash position. So they're the ones that we have. So we've changes in non-cash expenses and then changes in stock, debtors, and creditors. Okay. So we start off with this 337000. Now I'm going to do the easy ones first, which are the stock, debtors, and creditors. So what's happened to stock? Stock has gone down by 135 down to 111, so it's gone down by 24,000. When stock goes down, we are carrying less stock, which means cash will go up. Now, whatever it is, so that in this case here, it is a change in stock, but this one here is a decrease, so we should call it a decrease. Then our debtors. So debtors have gone up by 200,000. If debtors go up, in effect sales go up, but our cash position actually hasn't gone up, so we have to take that away. So an increase in debtors is the opposite to a decrease in stock. So our profit has gone up by 200,000 because our sales have gone up by 200,000, but our cash has not gone up by anything. It stayed the same. So when we're looking at our cash position, of the 337,000 increase in profit, 200,000 of it is to do with sales that we haven't been paid for, so we'd have to take that away. And creditors follows the opposite rules to stock and debtors. So if creditors go up, as they have in this case, our cash goes up. So if creditors go up, our purchases have gone up, which has reduced our profit. But if our credit purchases have gone up, it actually hasn't reduced our cash. So we have to add that back on. So that's going to be our, how much is there? 14,000 gets added back on. Okay. So that brings us to our depreciation, our profit on sale of buildings, and we should also check for bad debt provision, which would obviously be with debtors. Now I'll do that now because there is no bad debt provision. But if there was, increase in bad debt provision would be added on, decrease in bad debt provision would be taken away. Anyway, we look at our assets. So we'll do the profit on the sale of building. The information will always be given down here. So buildings which cost 90,000 were disposed of at a profit of 13,000. So it tells you what the profit is. So profit is a non-cash earning. So it's added on to your trading profit and loss account. So when we adjust or reconcile our cash to it, we have to take it back out. Our depreciation then, our depreciation will be accumulative, or there'll be a little bit of a working involved. There's often a working involved in the profit on the sale of building as well. Actually, you just have to be conscious that it's not always given down here. Sometimes you have to work it out. So with our buildings, or sorry, with our depreciation, we've two assets. We've got our land and buildings and our machinery. Now you can see that depreciation on land and buildings has gone from 110 up to 120. But you have to remember we've sold a building, so therefore we've sold its depreciation. So the depreciation for the year will not be the difference between those two. It's going to be more than that. Now it may tell us at the bottom how much the depreciation is, or you may be given the information to work it out. So let's go down and have a look. We're told the buildings were sold at a profit, and then if we go further down, depreciation for the year and arriving at operating profit includes 12,000 on buildings. So the depreciation, I'll just do it down here. The depreciation on the buildings is 12,000. Okay, now you might be able to tell me. Obviously, don't do it if you're in study. Answer questions to someone talking to you on a microphone. If this is 110 and there's depreciation of 12,000, how much depreciation must there have been on the building that we sold? You can have a think about that because we'll need that later on. Okay, the second part then, there's no disposal of machinery during the year, so we haven't got rid of any machinery, therefore we haven't gotten rid of any depreciation. So the depreciation on machinery has got to be the difference in the 165 and the 225. So the difference between 165 and 225 is 60,000. So 225, sorry, and minus 165. So if you started off with 165 depreciation and you ended up at 225, there must have been a charge during the year of 60. So the total depreciation is the two of those added together, which is 72,000. So then if we go and finish that off, you get 234,000. Now, as I said, there's loads of different ways that depreciation and profit on sale of buildings can be asked, and you just have to read them carefully. Make sure when there's two assets you're taking into account the two assets, and just work through. As I said, if you are told the depreciation on the buildings, more often than not they won't tell you the profit, and you can work it out, and we'll see that in other questions. Anyway, that's our first of our two reconciliation statements done. So that's probably worth another 18 marks or so, 20 marks as well. And then you get on to your cash flow statement. Now your cash flow statement is your proper document, and it follows a specific layout. So I'm just going to move over here, and I just we'll go through this. Let's make this a little bit smaller. There we go. So anyway, you can see the layout. Now, what makes, I suppose, these tricky, well, they're not actually tricky at all. You have to learn the layout, okay? So you just have to learn off the skeleton. Now, the difference between higher level and ordinary level with these cash flow statements is very minimal. At ordinary level, they tell you the headings. So the headings are what I have in red here. Operating activities, return on investment, taxation, capital expenditure, financial investment, equity dividends, management of liquid resources and financing. And you have to have them perfectly right, because they're headings that must be given under financial reporting statements. So you have to have them right for your leaving cert. So sorry, just want to stick in an extra line here. Okay, so the first one is operating activities, and what goes under operating activities is your answer from your first reconciliation statement, which was 234,000. Now you need two columns for these. You'll only use the first one very late on, so nearly everything going in the first one. Now the cash flow statement, just records movement in cash. We'll see this as we go. Anyway, investment income received. So we know that we are supposed to receive €3,000. We worked it out back when we did part A. What this is showing us what we actually pay, what we did actually receive. Now the rules for these, I'm just going to go down to the bottom just to show you these. For nearly all of these, well, certainly for tax, debenture and investment interest, to find out how much we've either paid or received, we take last year's, I'm just going to write this down, last year's, we add on last year's, that's from the balance sheet, we add on the charge from the bottom, or in effect from part A, which nearly are always in the workings, and then we take away this year's balance sheet balance. Good news is Ryanair have a sale on at the moment. Now, so let's look at that. So last year's balance for the investment income was €2,000. We can see that here. See that the investment income due was 2,000. So I'll just write this down. So we've got 2,000 from last year. The charge from part A we worked out to be €3,000. Now it's important you try and keep, you do keep using the same numbers. Don't go off because if you get it wrong, they'll give you the marks for taking this €3,000. So it's the investment income of €3,000. And then, so we were owed 2,000. We're supposed to earn another 3,000, and then at the end of the year, we're still owed 3,000, which we'll take away, which means we must have been paid €2,000. So we were owed 2,000. We were supposed to get another 3,000, and then at the end of the year, we're still owed 3,000, which means we must have been paid €2,000. So even though we were supposed to receive 3, we actually received 2. Now, these are all any positives. Anytime we're receiving cash, we put it in as a positive. Anytime we're paying cash, we put it in as a negative. Now, the second one, we do the same thing, debenture interest paid. So let's look at our debenture interest due. So at the end of last year, we owed 15,000. At the end of this year, we owe 10,000, and from part A, we should have paid 25,000. So let's look at that. So debenture interest. As I said, last year, 15,000. Add on the 25,000, and then take away this year's. So this year's debenture interest is 10,000. So that will be 30,000, is it? So let me just see. So it equals 15,000 plus 25 minus 10. Minus 10, given that one. So that's 30,000. So that's a minus. We're paying 30,000. So even though we were supposed to pay 25,000 this year, we actually paid 30,000. So we paid off some of what we owed. So we owed 15,000 last year. Now we only owe 10. So we paid our 25 plus an extra 5. Okay. Now we do the exact same thing with taxation. Now it's actually a little bit easier with taxation. It tells you how much you're paying. We're paying the last year's amount in full, which is 45,000. Doesn't always. We'll just follow the same process, right? We know the answer will be 45,000, but let's look at taxation. We've got last year's taxation of 45,000. We've this year's charge, which, if you remember rightly, was 110,000. See it there, 110,000. And then we take away this year's, which is 110,000, which means we paid 45,000, which is to be expected given that it tells us we paid 45,000. Okay, it tells us there the corporation from last year was paid in full. So that we've paid that minus 45,000. Oh, sorry. So we move on then to our next heading, which is our capital expenditure and financial investment. And this looks at our fixed assets. Have we bought or sold any fixed assets? And if we have, what has been the cash position or the cash return from that? So we look at them all. So we have got we've three fixed assets. We've two fixed assets. Sorry, we've buildings and machinery. Now we know because it tells us that we sold buildings. All right. We know because it tells us that we didn't buy any buildings, or certainly we can. Or sorry, I don't know what I'm saying there. We actually did buy buildings. We'll have a look at that. Anyway, we know we sold land and buildings, and we know that we bought machinery. And we know also that we bought land and buildings, and we'll show you how we know. Alright, so there's going to be three of them. So we sold a fixed asset, so in this case I'll change it to buildings. We bought a fixed asset, so in this case again, buildings. So payment to acquire buildings. And we bought machinery. Now how do you know? Well, if the cost figure goes up, you've bought something. So land and buildings have gone up from 780 to 850, and they've actually gone up by more than that 70,000. Machinery's gone from 230 to 349. Alright, so we know we've done that. So let's we'll go with the machinery one first because it's the easiest. So we're paying, so it's going to be a minus. So how much have we paid for our machinery? We didn't sell any machinery in the year. So machinery started at 230. It didn't go down because we didn't sell any machine. So it's gone from 230 up to 349. So we must have bought machinery that cost us 119,000. So the difference between the 230 and 349 is 119,000. Now I'm going to do the payment to acquire buildings next. So let's look at that. Buildings have gone from 780 up to 850. But before they go from 780, buildings actually go from before they go up to 850, buildings go from 780, and we sold buildings which cost 90, so we have to take away that 90,000. So really, buildings at the end of the 31st of the 12th, or somewhere during the year of 2011, are 780,000 minus 90,000. So buildings start off at 690. So really, buildings are going from 690 because we've disposed of this 90. So 780 minus 90 is 690. And then they're going from 690 up to 850. So 690 up to 850 is a 160,000. So 690 up to 800 and so what's it up to 850 is an increase of 160,000. So our payment to acquire buildings is 160. Obviously it's a payment, so it's a minus. Okay, we're running out of cash. Sorry, that was a minus as well. So that just leaves us with the receipts of our assets. Now, it tells us that there was no disposal of machinery, so there can't be any receipt. We sold buildings at a profit of 13,000. That does not tell us how much we got for the buildings. It told us we made a profit. So for us to know how much we got, we need to know the depreciation, which is why I asked you earlier on to have a think about what the depreciation might be on the buildings might be. So I'm sure some of you got the answer as 2,000. Now, how do we know that it's 2,000? Well, buildings depreciation last year was 110. This year's charge is 12,000. So if we hadn't have disposed of buildings and its depreciation, this would go from 110 plus 12, so it would go to 122. It hasn't. It's only gone to 120, which means the disposal on the of the depreciation on buildings must have been €2,000. Now again, this isn't really something we can give you notes on or anything, because this changes in each question. So the way they give these out changes, but you're basically looking at what you start with and what you end up with and what changes happen in the middle, and that's how you work all these things out. So 110 up to 120 would mean there's depreciation of 10, but we know that there was depreciation of 12, so 110 plus 12 is 122, which means there must have been depreciation on the one we sold of 2,000. So that's gone from 110 then to 108. 108 plus 12 is 120. So again, what does that mean to us? It means the value of the building we sold was 90,000 minus the 2,000. Tells us the cost price of 90,000 minus 2,000. Depreciation, which we just worked out, so its value is 88,000. We're told then that we made a profit, and the profit was 13,000. So if something is valued at 88,000 and we make a profit of 13,000, then we must have sold it for 88 plus 13, which is 101. Okay, so we've received 101,000, so that's a plus. Okay, so the overall effect of that is minus 170 something or other. Okay, anyway, next step, last one, is the dividends paid. Now again, you would generally, with dividends paid, follow the rules of last year plus the charge minus this year. So we'll do that. Okay, I'm just going to I'll do it here, stick in a couple of lines here. So we've got last year's dividends, which is none. There are no dividends last year. If there were, they would be in creditors less creditors amount falling due within 1 year. So it's last year's plus the charge. We worked out the dividends charge, if you remember, in part A to be, where are you? Dividends 40,000. So it's 0 plus 40,000. And again, there are no dividends due at the end of the year, so minus 0. So the answer is 40,000. Okay, so our dividends paid during the year is 40,000. So that's a minus. Okay, so at this point now you have to show what's called the net cash inflow or outflow before liquid resources and financing, which is the answer up to this point. So it's the 234, adding on any of the amount we've received and taking away anything that we've paid out. So I'll just do that sum there. And you get minus 57,000. That means it's a net cash outflow. An outflow is your cash has fallen. Okay, an inflow is your cash has increased. Okay, so that gets us to our last two, the purchase of government securities. Government securities are here, always in your current assets, and it's basically just going to be the difference between last year and this year. The government security is basically a government bond. It's like an investment, so the government will give you a return on it. So if they're in current assets, it means you've bought them. So they've gone from 0 to 60,000. So we have spent 60,000 on government securities. So that'll be a minus 60,000. It doesn't matter that we own them. We've spent the cash to buy government securities. Now that just leaves us with our financing, which is all in our finance buy. So this is money we got in from either getting a loan, or money we might have spent from repaying a loan, or money that we've gotten in from shares and share premium. So let's look at the loan first. We had a loan of 250. We now have a loan of 200,000. So we have to have repaid 50,000 euros of the loan. So that's minus 50,000. Now let's look at our shares. Shares have gone from 600,000 to 800,000. So we must have issued 200,000 shares. So we will receive 200,000 in cash. We'll actually receive more than that because our share premium has gone from 100 up to 120. So we're getting a further 20,000 in cash. So it's, if we just add those together, you get a financing position of another 170. So then it's minus 60,000 here, plus 170 gives you an increase in cash of, and obviously taking the starting off the minus 57. So the increase in cash is minus 57, minus 60, plus 170 is 53,000. If it's plus, it's an increase in cash. If it's minus, it's a decrease. Now you can actually know your answer before you do any of this. Alright, so if we look at our cash position is money we have in the bank, basically. So if we just look at the difference between our cash from last year and this year, which in effect is our bank. So the difference between the 22 and the 75 is 53. So our bank has gone up by 53, which matches this. Now it's not really that. There's a little bit more to it than that, because most of the questions have more than cash. So it would be the difference between your bank positions, and then you have to also add on to the differences in your cash positions. And also just bear in mind that you could have a bank overdraft. So a bank overdraft is the same as a bank. Bank overdraft is just a minus bank. So if you had a bank overdraft of minus 10 here, and you had nothing over here, and then you had bank of 10 here, that in effect is an increase in cash of 20,000. So it's gone from minus 10 to 0 to plus 10. So just be aware of that if you are trying to work out your answer. But your cash position is basically the difference between your bank added to the difference in your cash. Okay, so that's the main part of the question finished. The last part is your reconciliation of cash to movement in net debt. Now you'll find I don't even have this done in the skeleton. Now I should do, because it's as important as any of the rest of them. It's only worth 5 marks, but it's a relatively straightforward 5 marks. So it's called the reconciliation of net cash to movement in net debt. Now, what this is it shows you how much what's happened to your debt because of changes to your cash. So you start off with your increase in cash. So your answer is 53,000. That was your answer from the very first part, right? And then we say, well, what's happened to our liquid resources? Okay, now liquid resources, if you remember, are your government securities. So cash used to purchase liquid resources. Now for liquid resources, you can read government securities. So look at it. Government securities have gone from 0 to 60,000. So the government owe us 60,000 euros is really what that means. So our debt position, not only is our cash gotten better, but the government now owes 60,000 euros. So that's a plus. Okay. We have repaid debentures. So we have repaid 50,000 euros of debentures. And again, that's a good thing for our business. We owe less money, so that's also a plus. So our change in net debt is 163,000 euros. So we're 163,000 euros decent because of our position. So the government owe us, as a result of us buying government securities, 60,000, and we've repaid 50,000 euros of debentures. So our debt position has improved by our cash 53, our liquid resources of 60 and our debentures repaid of 163. Now at this point, that's known as the movement in net debt, or the change in net debt. Now, then we look at what debt we had at the start of the year, and then we look at net debt at the end of the year. Now, what net debt is basically your sorry, I don't know where I'm moving to. It's basically your debt from here. So, what did we have last year? So let's look at what the debt we had last year. We had 250,000. So this is the first of the first. So we had a loan of, we had debentures of 250,000. I'll move that over here. 250,000. Then let's look up. Do we have any bank overdraft? If we do, that would be net debt. Okay, we don't. We then take away our bank of 22,000. So the money we have in the bank is money that's owed to us in reality. So it's like the opposite of debt. And we also take away, so we would also add cash if there is any. So cash will be up in the current assets. There is none. Sorry, we take away cash. What am I saying? So if there's any cash balance, you would take it away, and you would also take away government securities. So it's your debentures plus bank overdrafts. I'll just put that in. I just want to. It's debentures, add your bank overdraft if there is one. So in this case it's 0. So debentures plus bank overdraft would be the debt that we have, and then you take away the money that's owed to us, which is the money we have in our bank, and any cash we have, and any government securities. So in this case, all three of those are 0. So our net debt position 228. Okay. So net, because it's in effect a minus, like our debentures are bigger than everything else, that's a minus. So then our net debt position at the end of the year, if we started off with 228 and in effect we reduced it by 163,000, the difference in the two of those is 65,000. We should have net debt this year of 65,000. So if we look at that, if we compare the end of the year or last year to this year, let's look at our debentures. They're 200,000. We still have no bank overdraft to add on. We have a bank now of 75,000 to take away. We still have no cash to take away, but we have government securities of 60,000 to take away. So it's 200,000 minus 75,000 minus 60,000, which is 200,000 minus 135. So that is 65,000. So our net debt at the end of the year will be this 65,000 here. Okay, so that's our working for that. That's worth 5 marks. Now, it's bloody important, 5 marks. A lot of people leave it out for no reason. It's quite straightforward. Don't, please, I'm asking you, do not stop when you get to the end of the cash flow statement. So I want you to start putting that, make sure you put that in into every question you practice. Okay. What you will have, really important in these, is that you will have a heap of theory at the end of them, which makes them a little bit trickier for most people who like accounting. You don't have a heap of theory, but you have theory worth between 10 and 15 marks. Now, the first question is really, really easy, and it's the basis for what cash flow statements are. So it's explain why earning profit does not always result in a corresponding increase in cash balances. Use figures from your question to support your answer. So we can say that not all profits are not all profits are cash. Not all increases in profits are cash. So a decrease in bad debt provision would be an example of a non-cash profit. A profit on the sale of a fixed asset does not lead to any extra cash coming into your business bar the cash received for the fixed asset, and an increase in credit sales increases your profit but does not increase your cash position. So you can look at those numbers. So the increase in or the profit on the sale of the building increases your profit by 13,000 but does not increase your cash by any euros. The increase in debtors increases your cash sales by 200,000 but does not increase your cash position in the bank by any by zero. Okay, so that's our first one. The second one is outline two responsibilities of the directors of a PLC. Now, that's just stuff you have to learn. It'll be in your notes up online. But the directors have a legal responsibility to comply with the Companies Act. That's the most important part. If you don't comply with the Companies Act, which is all about preparing accounts properly, all that sort of stuff, you can be barred as a director. The directors are obliged to prepare financial accounts, and to get those accounts audited, they have to sign off on the financial accounts. They have to publish accounts. They have to prepare cash flow statements once a year. They have to present a report at the AGM of the business. So, and I suppose they're probably looking for 2 or 3 of those to finish them off. Anyway, that's our cash flow statements. I would suggest giving a whole heap of these goes between now and your mocks. We will finish them over the next week or so, and just don't get too frustrated with them because each one is very different. So sometimes it just takes to have a go at them, have a look at the marking scheme, and maybe go back and give them a go a second time a few days later. Anyway, Shin A, and we'll see you next week.